Ever wondered why the market finally moves in your direction, but only after kicking you out first? That's not bad luck. That's inducement. It's the move before the real move. Institutions purposely lure traders into early positions, trigger retail stops, collect liquidity, and then drive price in the true direction. In this video, I'm going to break down exactly how inducement works, why it manipulates traders so easily, and how you can flip the script to avoid traps, spot engineered fake moves, and catch sniper-level entries with confidence. What is inducement? Inducement is one of the most misunderstood yet powerful smart money concepts because it explains why price often makes traders enter too early and then reverses to hit their stop loss before moving in the exact direction they expected. Inducement occurs when a market creates a tempting move, often a minor pullback, a small order block, a micro break of structure, or an apparent early entry signal that encourages retail traders to jump in prematurely. But this early signal isn't the real opportunity, it's the trap. Institutions use inducement to generate liquidity. They need traders to enter so that their stop orders, both buy stops and sell stops, accumulate around these early, fake levels. Once enough liquidity builds up, price deliberately sweeps those stops, grabbing the liquidity required to fuel the real move. This is why so many traders feel manipulated. The market goes in their direction, but only after it wipes them out. Inducement is essentially the market engineering a reason for traders to enter first, so their stops can be used as liquidity. Understanding inducement helps you avoid these traps and instead position yourself after the liquidity grab, right when institutions take control. Once you learn to identify inducement zones, such as early pullbacks, engineered equal highs/lows, micro order blocks, fake breakouts, or premature breaks of structure, you stop being the liquidity and start trading with the smart money, entering after the trap and capturing the real move. Types of inducement. Inducement comes in several forms, and each one is designed to lure traders into taking the wrong side of the market just before the real move begins. One of the most common types is fake breakouts, where price slightly pushes above equal highs or dips below equal lows, making traders believe a breakout is happening, when in reality, it's just collecting orders. Another form is microstructure breaks, small short-term breaks of structure that convince retail traders a trend has shifted, even though higher time frame structure still points the other way. Then you have mini pullbacks or shallow retracements that tempt traders to enter prematurely, thinking they're catching the early trend, while institutions use this moment to load positions. There is also range inducement, where price consolidates, creates a false direction inside the range, and tricks breakout traders into jumping in before the real expansion. Finally, there's trendline inducement, where the market intentionally respects a trend line multiple times, encouraging traders to trust it, only to spike through it, grab their stops, and reverse. All these patterns serve one purpose: create interest, trigger early entries, build liquidity, and fuel the true institutional move right after the trap has been set. Inducement Entry Model. The Inducement Entry Model focuses on entering after the market has created the trap, collected the early liquidity, and revealed the true intention of price. Institutions rarely enter at the first signal. Instead, they form a fake opportunity to lure retail traders in. This fake opportunity may look like a breakout, a small pullback, a structure shift, or a mini trend that appears to be the beginning of a real move. Retail traders jump in immediately, placing their stops in predictable locations, below the pullback for buys, above the tiny breakout for sells. Once enough traders are trapped, smart money reverses the move, sweeps those stops, and fills their orders at a discounted or premium price. Your job is not to enter during inducement, but after the inducement is taken out. The model becomes clear when you see 3 steps. Inducement forms, a micro move that attracts impatient traders. Liquidity sweep. Price reverses and takes their stops. True displacement. The real direction begins with momentum. After the sweep, the market leaves a strong displacement candle, breaking structure in the true direction. That displacement creates imbalance or a fair value gap. This is your entry zone. When price retraces back into that FVG or the origin order block behind the displacement, that's the sniper entry, the entry that institutions actually use. Your stop loss is placed beyond the inducement sweep, and your target is always the next liquidity pool aligned with the real move. This model works because you're trading the reaction to inducement, not the inducement itself, leaving you with extremely high accuracy entries and minimal drawdown. Inducement isn't just a trap, it's the roadmap institutions leave behind. Once you learn to spot the fake move before the real move, you stop chasing price and start anticipating it. The market will always create liquidity before shifting direction, and the traders who wait for inducement confirmation get the cleanest, safest, and highest probability entries. Master inducement, and you'll never fear manipulation again. You'll profit from it.